Hey everybody, welcome to the weekly wrap-up. My name is Gareth Soloway here with VerifiedInvesting.com, and we're going to go over last week's action this past week. We're also going to look ahead into next week because there are some major things going on that every trader and investor needs to know. So, number one, we have constant kind of chatter about Trump firing Powell. And again, we're going to talk a little bit about that and why that is very, very unlikely to happen. We're also going to talk about Netflix earnings. We're going to talk about Google and the antitrust case and the levels to buy that should it continue to dip, as well as the likely coming earnings season and the big movers. So first and foremost, follow me over. We're going to take a look at the S&P 500. So what we saw last week in the markets is essentially a choppy sideways week. Now, again, what we saw here, again, this is that big day about 2 Wednesdays ago, massive move up. And then look at this. Since then, we've formed what would be referred to in technical analysis as a flag pattern. Now, again, this pattern is actually bullish. Now, remember, a bullish flag or a bull flag doesn't guarantee upside, but it makes it more probable. So as a trader, you need to be saying, okay, the probabilities are favoring the upside, though it's not a guarantee. Why isn't it a guarantee? Well, if Trump fired Powell on Monday or Tuesday, you guarantee that the markets would drop at that point. But that, again, is not in the cards at this point. So we have a little bit of a wedge, which forms a bull flag. Upside resistance remains this level right here. All right, so that is your short-term resistance. It's around 5,700 on the S&P 500. Now, why is that resistance, right? If the flag plays out and goes up, why is it going to meet resistance at that point? The reason is very simple. Number one, this is what's called a gap fill. All right, you basically closed here and you open down here, creating this void, which is in technical analysis a gap. So gap would be filling. The next factor would be, right, so if we look at this, you have all this sideways chop for literally 2 to 3 weeks in the market. There were a lot of sellers, right? So in all fairness, there were a lot of sellers in here, but there were also a lot of buyers, all right? All those buyers were thinking, oh, let's buy into the S&P here because we're going to rip to new all-time highs. So they all got in, and then basically they just got clobbered on this drop. So the tendency for us and psychologically as traders and investors is to say, okay, I didn't expect this drop. It was really scary. And now I have this feeling that if I can just get back to break even, right? So gap fill, I'm going to exit and sell into that. And so you have all these buyers here, all these from in here that will likely sell right into that gap fill. That's why gap fills work as resistance when price comes from the underbelly of a big down move. So again, in general, should the flag play out, 5,700 on the S&P would be appropriate. Now let's take a look at the bigger picture. The bigger picture, this is such a great chart because it really shows how two trend lines that converge. So you could have trend lines in any direction, right? I mean, right like here, if price comes in to what we call kind of a necktie right there, that midpoint where the two cross, that ends up being support, or from the underbelly, it would be resistance. Okay, so if we look at what the markets did, we had this big bull market run, and then we had the big dump, and where did it stop? At those two trend lines right there. Now, you might say, okay, is this the end of the downside? Could we be entering a new bull phase going back to all-time highs? Anything is possible, but it is highly unlikely, and I'm going to show you why in just a minute. So again, we've had a hit of this down here. We've bounced, and now we're flagging. I still think there might be a little bit more upside, but my analysis is showing that eventually we turn down and make new lows and break this technical support level. All right, follow me back to the computer here. Let's take a look at what we have, and I'm going to show you why I think it's unlikely that the bull move is over. So let's go to my laptop here and take a look at this chart. What we can see is that this is a great parallel. The parallel is a parallel channel that literally marks the exact low of COVID, the bear market low, and then if you stretch that parallel up, like so again, all I did was I drew a trend line here, and then I stretched it up to the bull market high of 2022. And what we see is in 2024, we tagged that line. Now, using logic, which is really underestimated in how important it is in trading, but it really makes for great traders, we see that when we hit this line, we came back here. When we were at this low, we went up to this line. Then when we were at this low for the bear market of 2022, we went to the high of this. So by default, what would we be expecting to be our downside target? Right here on the markets. And again, that would imply that we would make new short-term lows on the NASDAQ. That would take us to about 13,700. Another chart to watch is this one. This is a beautiful chart here. This goes back to 1929 on the logarithmic scale. What we can see here is this is the 1929 high on the stock market before the Great Depression, the high right here before the dot-com collapse, and lo and behold, look at what we just hit right there. And this is the downfall. Now, you could say, okay, well, we've pulled back. Well, we pulled back here in 1929. We obviously had a massive drop as well. But if you look at the percentage drops from 1929 to the lows, it was about an 85% drop. If you look at the high to the low from the dot-com bubble, it was about a 50% drop. So does it make sense that this would be the end of the move when it is only from peak to trough 21% on the S&P? I would kind of argue and say it's more likely we're going to go down further, maybe as high as, let's say, 50%, which would match the dot-com correction. In the very least, you would assume it would be a bigger drop because each time we hit this, I mean, basically the average of these two hits is about 65, 70% drop. So again, you'd have to think somewhere in that vicinity we could be starting out from. All right, we're going to flip over to the 10-year yield. Now, I'm going to go back to the big screen here because I think this is a very, very important thing to take a look at, right? So what we have here is looking at this chart, we see the 10-year yield was in a downward trajectory. And then all of a sudden, when the stock market started to collapse based on the trade war, we saw instead of yields going down, which is what they should have done, they started to rip up. We broke out above this level, and now we've come into support. Remember, so the big, in technical analysis, the big methodology point is that you have resistance, 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 but when resistance is finally broken, it now becomes support. Okay, and therefore the retrace is now likely headed that way. So that's an important kind of methodology point that we have to understand in technical analysis. And if this is correct, yields actually are slated to go a little bit higher here in the near term. Now, remember, we talked about at the beginning how Trump has been talking about maybe firing Jerome Powell. The reasons why that is very unlikely is if he fires Jerome Powell, it would basically make the whole world question the dominance of the U.S. in terms of, well, if the president can just fire anyone at the central bank at will, what kind of investment are we making in the U.S. by buying treasuries and buying these other things? So the idea is that if that happened, yields would likely shoot up north of 5%. And interestingly enough, what do we know? We know that because of this move, this is the reason why Trump backed off on the European tariffs, because this was putting so much pressure on the financial system with higher rates, with $9 trillion to refinance in U.S. debt, that he needed to back off so yields would pull back down. So listen, trade war, it's likely still going to inch back up off this support. If it breaks, that would be actually a very good thing. It would probably tell us that we have a calm down in the trade war. But ultimately, based on charts, we're going to go at least a little higher in the near term on yields. The one thing you don't want to see is essentially Trump getting fired. He's out of a job by next May anyways. His term comes to an end. We just got to wait it out, or at least the president just needs to wait it out. All right, let's go back to the computer here and take a look at the U.S. dollar. And the U.S. dollar, again, shows us a lot of troubling factors. Let's take a look at the screen here. So we see that the U.S. dollar, in spite of being the reserve currency, continues to break lower. That, again, is showing that people around the world are questioning if the dollar is as sound as it once was with all this craziness going on in the U.S. at the trade wars. So just watch that. That is absolutely something that needs to be monitored. In terms of support, we did hit a little short-term support. We can see right here, if we stretch this line over, we can see right here again, this little shelf right here, short-term support. If that breaks, we're likely going down on the DXY to about the 96.80 level down there. And again, a weaker dollar, it can be good for trade, right? It can absolutely be good for trade, but it also means that, again, the dominance of the U.S. dollar in the overall market is fading. And that can be a bigger problematic factor when we have as much debt as we have. We need other countries to want and buy our debt and buy U.S. dollars to keep us as that dominant reserve currency, which gives us, believe it or not, a lot of power around the globe. All right, couple stocks in motion. Taking a look here, we have Netflix reported earnings Thursday after the close. Remember, this won't trade publicly with the market open until Monday. But again, Netflix was up a little bit. This looks like a big move. It's actually only 3%. Now, they had great earnings. They beat on earnings. They beat on revenue. But why wasn't Netflix up more? The answer is very simple here. So we come back to me, right? So the idea here is that early in the week, we saw a memo leaked on options expiration week that Netflix had this big meeting and they were going to be aiming for $1 trillion market cap. Essentially, it was kind of guiding everyone to know that their earnings were going to be spectacular. So if we go back to the charts here, we can see that Netflix rallied sharply on that news all the way up into earnings, and then earnings came out really good, but basically it's barely moving. Like literally we're trading right around here in the after hours on Thursday. And so again, the idea being is that this was already factored in, and that's why you're not getting a bigger move up on Netflix. Now, for me as a trader, I'm watching double top resistance at 1065, and then on the downside, should it start to dump out, if the stock market dumps out, look at the beautiful trend line here. I mean, this is just an amazing one going back to October 2023, hits here, and we just hit it. This is the support level, but if it breaks, watch out below. But resistance at 1065 and support at approximately 850. Now, Google, we got to talk some Google action. Take a look at the intraday action on Alphabet during the market on Thursday before the holiday here on Friday, and ultimately a big drop after antitrust and a judge ruled that they basically are monopolistically keeping competitors down. That stock took a dump. Now, it did recover quite a bit. I think part of the reason, again, the stock is down 27% from its recent highs in February, so it's already factoring in that there were going to be problems with this case, and that's why, again, it only fell about 1.42%. Now, in terms of trading, is there a level to watch? The answer is absolutely. I have a big level here. I think it's right around 131, 132 that I'm eyeing as a swing trade. Why? Well, number one, you have a pivot low here. Number two, if we take a Fibonacci tool and we do it from this low to this high, look at what that level lines up with. That level lines up perfectly with the 618 Fibonacci retrace. Okay, so in technical analysis, one of the strongest cases for bull rallies or bear pullbacks is when you have multiple factors that coexist at the same level. It's essentially like a necktie with two trend lines crossing or two factors crossing. In this case, it's a Fibonacci level and it's also a major pivot low. So as a technical trader, I'm going to be eyeing that 130, 132 area as a swing trade buying opportunity for us to make money on in the services here. So again, stay tuned on that one. Next up, let's flip over to Bitcoin. Bitcoin again, guys, beautiful little bull flag continues. I continue to be bullish on Bitcoin just in the short term. Mid to long term, I'm still a little bit nervous about if the stock market really dumps out more. But there's no doubt that money has been hiding. And I think this is the key, guys, is that if the dollar was still the safe haven and wasn't collapsing, if the treasury market wasn't in turmoil, Bitcoin would probably be a lot lower. But there's a certain amount of money globally that is finding a home in Bitcoin right now, and that is keeping it up and actually has broken above this beautiful downsloping trend line. Again, in terms of resistance, a small resistance at 88,500 and then 92. Those are your two levels to watch on the upside. Altcoins, by the way, I was looking at some of these. XLM is one of them. And again, I don't really go over a lot of these altcoins, but man, I'll tell you, some of these really look intriguing for breakouts. Look at the XLM, this downsloping trend line is trying to break above this level. Ethereum, if we look at ETH here, look at this, same kind of deal, downsloping trend line. It's creeping above this downsloping trend line, trying to break out. So honestly, altcoins actually look very, very good right now as well. Gold. All right, gold is nearing an X marks the spot. X marks the spot, just like we've talked about in this wrap-up video. That is going to be major resistance. We'll see if gold can make one more big move up into 3,400. But then look, you have two parallels, amazing two parallels, one going back to the high in 2020 and the low here. Another one, if we flip to the weekly chart, this is the bigger one that goes back to the bull market high of 2011 through these lows. And look at how those two parallels create an X. X marks the spot again, right at 3,400. That should be major resistance, and I do think you get a big 10% pullback off of that on gold. Silver continues to be kind of a non-event. I mean, compared to gold, it really is not doing much here. And you can just see, again, it's up above this line. So maybe it can get up to this level here, but very minimal price action. And then oil, remember I've been saying oil is making a bearish pattern, but could go back to 66 to 65. Sure enough, on Thursday, before the holiday on Friday and the weekend, it went up closer and closer to that zone. Same thing as I talked about earlier in this wrap up. This was support, right? So when support's broken, what do we know it becomes? It becomes resistance. So the idea is we broke it here. This now should be resistance. For me, I am looking to potentially short oil if we get up in here. look for that next leg down once it gets to 66 to 65. Lastly, natural gas, folks. Let's take a look at that. And if we bring up nat gas here, nat gas is just creeping below this trend line, major trend line here, but it has not confirmed a breakdown. So I'm a little skeptical until it confirms. That's just technical analysis to a T. Be careful. It's not a whipsaw by institutional money, but right now it's unconfirmed as a breakdown. If it does confirm, this is your buy level here, down around this 297 level. Major technical support right there. All right, coming back to me, folks. So listen. Next week, we have major earnings from Tesla. We have Google reporting earnings. We have a lot of major companies that'll be reporting earnings, so action is going to be insane. We want to watch for more chatter on whether Trump is potentially going to fire Jerome Powell. Again, I think that's unbelievably unlikely, like literally 99% chance he doesn't, maybe 1% chance he does, because it would literally crash the U.S. financial system for a short amount of time, and we already have stress on the financial system because of the trade wars. We're also going to keep an eye on anything out. We've heard good stuff from China. China and the U.S. may be starting to talk just a little bit. That could be a bullish catalyst for that bull flag on the S&P to make that next leg up, along with a potential European deal, Japanese trade deal, lots of potential trade deals that could be positive for the markets, again, pushing up from that bullish pattern. All right, so again, just to summarize, short term, I'm slightly bullish on the markets for an upside move on the S&P, while mid to long term, I do not think the markets have bottomed out yet. So essentially buying, holding into this, then looking to short again on any significant pop. All right, folks, thank you so much for being with us, for supporting Verified Investing, for understanding that we're not about the hype, we're not about the narratives, we're all about the data and the charts to give you guys a clear probability-based assessment of markets, including crypto, stocks, and commodities. We're here for you. You guys support us. We'll do the best we can for you. Have a great, great weekend. Take care.